It's great to have you both here. Jason, I'll just start with you because you're saying there's 5 things really that could cause a sell-off from here, and a couple of them certainly grabbed my attention. Run through them if you don't mind real quickly.
Well, listen, I think the most important one over time is just simply time. And I think one of the things we've looked at when we've talked to our clients is that there's been this difference, obviously, between the performance of the economy and the markets. And I understand people's hesitancy there, but by the same token, you usually don't have bear markets, in my opinion, that are associated with recessions that only last 1 month. And that's what we saw from February into March. So the most important one of the 5 would be time. Then you have things like political wrangling, negative interest rates. Those would be some of the other things that we would look at that, in my opinion, could set about a catalyst for a new decline in the markets.
Right. So we're sitting on the health front, political wrangling over stimulus. I get those too. But you also say the return of corporate guidance could cause a market sell-off. Negative interest rates, as you said, I'd like to hear why you think that would cause a market sell-off. And a Democratic sweep come November. You don't have to get too political about it. But what is it in particular about guidance and rates that you're concerned about?
Well, I think as far as guidance is concerned, right now, it's usually a little bit of art and science coming up with an earnings number as a strategist. And right now it's like modern art, or abstract art, because there's no idea. You have nothing to go on. I think in some ways people are giving companies as a result the benefit of the doubt and thinking that things are going to get better as the economy reopens, which is almost inevitable. Whether it's sustainable is another question. I think if companies really start making longer-term guidance that says, no, this is the real thing, this is going to take us some time to get through, that could be a problem. Negative rates, in my opinion, have been tried in Europe and Japan and have largely been a disaster. I think there are benefits to it, but most of the benefits are greatly outweighed by its negative impact on the banking system, which is really the oxygen upon which most economies breathe. So I think that would be a bad idea. I think the Fed's done all that it can do, or it may do a little bit more in terms of expanding the balance sheet, but negative interest rates, in my opinion, would be a bridge too far.
Well, let's bring in Bob on that very point. Bob, of all the questions I thought you were going to be reflecting, is the bond market dead, was not the main one. What made that kind of come up in conversation with clients in terms of what you see happening in the market, and what do we need to be concerned about?
Well, I think that a lot of clients are concerned that as the central banks are buying greater and greater parts of the bond markets, it starts with government bonds in the U.S., it's gone to agency mortgages. In Europe, it's gone to corporates. It's now corporates in the U.S. There's a sense that they're squeezing out the potential bond investor and bringing yields down to an abnormally low level. I think what they're forgetting is we're going to see an extreme amount of issuance. We're going to see trillions of dollars of government debt. Already this year, we've seen $1 trillion of corporate debt issued. There's going to be plenty for everyone to buy, and you have to think of it as co-investing with the Fed to help the recovery along.
Yeah, it's a point in terms of whether those purchases would kind of crowd out the private sector, so to speak, that some of the bears have emphasized. I believe Stan Druckenmiller might be one of them, who's kind of concerned about where all of this borrowing and buying is going. It's interesting, too, that people are worried about rates being artificially low when it sounds like they're trying to kind of continue to push them lower. Maybe putting all of that aside, what's your point of view on how low rates can go? I mean, does the Fed even need to go negative in order for large parts of the Treasury curve to go negative, corporate borrowing to go negative? We've certainly seen, people even issuing debt at negative rates, European issuers and so forth. We've seen that already.
Well, I know last July when I said I expected the 10-year Treasury to go to zero, you thought I was crazy. Let me tell you that when I heard Jay Powell talk about negative rates, and he said, not for now, that for now even caused me to gasp.
Really?
Because once you fall into that negative hole, nobody's been able to get out. No economy in Europe, and certainly not in Japan. So I hope they stay at zero. They need to create an affordable funding environment for all levels of government, for all businesses, and for households to be able to finance themselves I think Jay Powell called it a bridge for now. And I think the Fed has shown from 2015 to 2018 that they can normalize policy when the time is appropriate.
So in other words, Bob, you heard him say not now and also read that, as many did, as saying, hey, the door is open. Let me just ask you, for those who say, well, you work at J.P. Morgan, of course you don't want negative rates. Explain why that would be bad for the whole public, not just for the big banks.
Well, it's bad for savers, and there are so many savers in the economy that have money on deposit. If you look at money market assets, they keep setting a record high every day. So if you take rates to negative, do you just cap people off at zero? And if you take rates to negative, then you're going to bring bond market yields down towards zero and negative as well. So you tend to penalize savers quite a bit. And we know there are about 10,000 retirees, new retirees every day in the U.S. who need some form of fixed income.
Yeah.
Positive fixed income.
Right, exactly. Not negative fixed income. Jason, I'll just give you the final word here to kind of bring this back to the stock market. You guys have moved your investments kind of away from cyclicals, more into technology and communications. And when I saw that, I just wondered about if you're, chasing the consensus, so to speak.
Well, there may be a sense in which we're doing that, but I also think it has a lot to do with the length of time I think it will take for us to get back to the level of economic activity. It really has a lot to do with what I see as the shape of the recovery, which is to say I think growth is going to be impaired for a long period of time. I think the black swan wasn't necessarily the virus, it was the lockdown. We've done a lot of damage to the economy that will take a long time to repair. And I think in that environment, people are going to pay up for growth stocks. And I came into this year, I have to say, very bullish on cyclicals and value-oriented stocks, and that was largely because I thought with the trade war dormant, you would have a stronger year for global growth. And, we'll never know whether that would have been correct or not because of the virus and the lockdown. But as it stands now, I think, again, unfortunately, I think this will take some time to repair. And as a result, I want to be more in the growth orientation as it stands now.
Understood. Great chat, guys. Thank you both. Appreciate it. Jason Trennert and Bob Michael.